Your car insurance is probably more expensive than it was 2 years ago, maybe a lot more expensive. And if you're like most people, you've thought about it, gotten frustrated, and then just paid the bill because you didn't know what else to do. But there are real ways to bring that number down without gutting your coverage or putting yourself at risk. And most of them don't require you to change anything about how you drive or what you drive. You just have to know where to look and what to ask for. My name is Jim Eddington, and my agency helps individuals and families navigate exactly this. So let me walk you through what actually works. The first thing, and this is the one that makes the biggest difference by far, is shopping your policy. I know that sounds obvious, but most people don't do it. They get the renewal notice, they see the number, they're annoyed, and then they pay it anyway because switching feels like a hassle. But here's what's actually happening behind the scenes. Insurance companies reprice their risk appetite constantly. The carrier that gave you the best price 3 years ago may not be competitive for your profile anymore. Not because he changed, but because they changed. They may have had a bad year in your state, or they may have decided to pull back on a certain type of driver or vehicle. Meanwhile, another carrier may be actively trying to grow in your area and is offering lower rates to attract exactly your profile. We see this all the time. Someone comes to us paying $3,500 a year. We run their information through multiple carriers and we find them comparable or better coverage for $2,500. That's not a gimmick, and it's not because they were doing something wrong. It's just how the market works. The insurance marketplace is competitive, and the only way to take advantage of that competition is to actually shop. If you haven't compared rates in the last 3 years, there's a real chance that you're overpaying. Now, I do want to add a caveat to this because shopping doesn't mean just jumping ship every 12 months. There are real benefits to staying with a carrier. There are some companies that reward loyalty with things like accident forgiveness, where your first at fault accident doesn't trigger a rate increase, or diminishing deductibles that get lower the longer you go without a claim. If you're constantly switching carriers, you're resetting those benefits every single time. So the smart approach is not to shop every single year, it's to shop every 3 or so years or whenever your premium jumps significantly at renewal, and weigh what you'd save against what you'd give up by leaving. Now, the second thing is bundling, and this one is almost always worth doing if you're not already. If you have your auto insurance with one company and your homeowners or renters insurance with another, you're leaving money on the table. Almost every carrier offers a multi-policy discount when you bundle auto and home together, and that discount is typically 10 to 15% or more on both policies. So you're not just saving on your car insurance, you're saving on your home insurance too. But those savings are only part of the reason bundling makes sense. When your home and auto are managed under one roof by one agency, it's much easier to coordinate your coverage, especially if you add an umbrella policy down the road. An umbrella sits on top of both your auto and homeowner's liability. And when your agency has visibility into all of your policies, the underlying limits, the umbrella requirements, and the whole structure can be managed together properly. When your policies are scattered across different companies and different agencies, making sure everything lines up gets a bit more complicated than it needs to be. So, bundling isn't just a discount play, it's a better way to manage your overall protection. If you're renting and you don't have renter's insurance at all, it's worth knowing a renter's policy is usually somewhere between $15 and $25 a month. And adding that can sometimes trigger a multi-policy discount on your auto that saves you more than the renter's policy costs. So you end up with more coverage and a lower total bill. That math doesn't always work out, but it's worth checking. Something a lot of people don't realize is that your credit plays a significant role in what you pay for car insurance. In most states, insurers use what's called a credit-based insurance score to help set your premium. It's not your credit score exactly, but it's derived from the same information. Your payment history, how much credit you're using, how long your accounts have been open, and the difference between having good credit and poor credit on your auto insurance can be substantial. In some cases, $100 a month or more. Not every state allows this. California, for example, prohibits insurers from using credit in their pricing. But in most of the country, including Arizona, Nevada, and Utah, it's a real factor. So if your credit has improved since you last shopped your insurance, that alone could mean a lower rate. And if your credit isn't where you want it to be, improving it over time will benefit you not just on loan rates and credit cards, but on your insurance premium too. The third thing is your deductible. And this is one where you need to be honest with yourself about the trade-off. Your deductible is the amount you pay out of pocket before your insurance kicks in on a collision or comprehensive claim. If you're currently carrying a $500 deductible and you increase it to $1,000 or $1,500, your premium will go down. The savings vary depending on your carrier and your profile, but it's not unusual to save $150 to $300 a year by moving from $500 to $1,000. The trade-off is straightforward. If you do have a claim, you're paying more before the insurance starts covering it. So you need to ask yourself two things. One, can I actually afford to pay the higher deductible if something happens tomorrow? And two, how often am I actually filing claims? If the answer is that you haven't filed a claim in 5 or 6 years, then you've been paying a higher premium every single year for a lower deductible you never used. Over 5 years, that extra premium adds up to way more than the difference between a $500 deductible and a $1,000 deductible. So for a lot of people, the higher deductible is the smarter financial move. And while we're on the topic of claims, be thoughtful about what you file. Every claim goes on your record, and in many states, even a not at fault claim or a small comprehensive claim can affect your premium at renewal. If you've got a small windshield chip that costs a couple $100 to fix and your deductible is $500, there's nothing to file anyway. But when a claim is technically above your deductible, it's worth asking whether the payout is worth the potential rate increase over the next 3 to 5 years. Sometimes paying out of pocket is the cheaper long-term decision. That doesn't mean you should never file claims. That's really what insurance is for, but being strategic about it can keep your premiums lower over time. Now, the fourth thing is discounts. And I want to spend some time on this because most people are leaving money on the table without realizing it. Insurance companies offer a long list of discounts, and many of them are applied automatically, but not all of them. Most require you to ask, and some require you to opt into something. Safe driver discounts are the most common. If you have a clean driving record, no accidents, no tickets, most carriers give you a discount for that. But there are also discounts for taking a defensive driving course, which in many states knocks another 5 to 10% off your premium. It takes a few hours online, and the savings last for multiple years depending on your state. Low mileage discounts are becoming more common now that many people work from home. If you're not commuting 30 miles each way every day, your risk profile is lower than someone who is, and many carriers will reduce your premium if your annual mileage falls below a certain threshold. If your driving habits have changed since you first set up your policy, maybe you switched to remote work, or you retired, or you moved closer to your office, make sure your carrier knows about it. They can't give you a discount for something they don't know about. Pay in full discounts are another one people miss. A lot of carriers charge you more if you pay monthly than if you pay your premium in full for 6 months or a 12-month term. The difference can be meaningful, sometimes $50 to $100 a year. If you have the cash flow to pay up front, it's worth doing. Also, many carriers offer small discounts for paperless billing and autopay. Each one might be 3 or 4%, but when you stack 5 or 6 of these together, you're looking at a real reduction. Telematics is another option, and I know some people have strong feelings about it. Telematics is a program where you let your insurance company monitor your driving habits, usually through an app on your phone or a device plugged into your car. They're tracking things like how hard you brake, how fast you accelerate, what time of day you drive, how many miles you're putting on. If you're a calm, low mileage driver, these programs can save you 20 to 30% or more. Some carriers even give you an instant 5 to 10% discount just for enrolling before they've tracked anything. If you drive a lot or you have a lead foot, that can actually increase your premium depending on the carrier. So it's not for everyone, but if you're a low risk driver and you don't mind the monitoring, the savings can really be significant. The fifth thing is right sizing your coverage to match your actual situation. And this is where a lot of people are either overinsured or underinsured without knowing it. But before I get into that, one thing worth mentioning, especially if you're in the market for a different car, is that what you drive has a real impact on what you pay. A midsize sedan and a performance SUV can be several $100s apart in annual premium, even with the same driver, the same zip code, and the same coverage. The cost to repair the vehicle, the cost to replace it, the safety ratings, the theft rate for that vehicle, all of that factors into the premium. If you're shopping for a car and insurance cost is a concern, it's worth calling your agent and getting a quote on the vehicle before you sign the paperwork. I've seen people buy a car and then find out the insurance is $300 or $400 more per year than they were paying on their old vehicle. A 2-minute call with your agent can save you from that surprise. Now let's get into right sizing. I'll give you a couple of examples. If you're driving a car that's 12 or 15 years old and it's worth maybe $3,000 or $4,000 on the open market, you need to think about whether carrying collision coverage even makes sense. If you total that car, the insurance company isn't going to write you a check for what you paid for it or what it costs to replace it with something newer. They're going to pay you the actual cash value of the vehicle at the time of the loss. If that number is $3,000 and you've been paying $600 or $700 a year in collision premium, you're spending a significant chunk of the car's value every couple of years just to insure it against physical damage. For some people, it makes more sense to drop collision and comprehensive on an older vehicle and put that premium savings into a rainy day fund. You're essentially self-insuring the physical damage risk on the vehicle that isn't worth much. But, and this is important, this does not mean dropping your liability coverage. Liability is non-negotiable. That's the coverage that pays when you injure someone else or damage their property, and those costs can be enormous regardless of what car you're driving. A 20-year-old Honda can cause the same accident as a brand new BMW. Your liability limits should reflect your financial exposure, not the value of your vehicle. On the other end of the spectrum, some people are carrying state minimum liability limits, and they really shouldn't be. State minimums are designed to be the legal floor, the absolute least you can carry and still legally drive. In many states, those minimums are dangerously low. If you carry $50,000 in liability coverage and you cause an accident with $200,000 in injuries, you're personally responsible for the $150,000 gap. If you own a home, you have savings, or earn good income, state minimum liability is not enough. Increasing your liabilities from the minimum to something like $100,000 per person and $300,000 per accident often costs less than you'd expect. Sometimes $50 to $100 more per year, and the protection it provides is substantial. And if you watched our video on umbrella insurance, you already know that an umbrella policy sits on top of your auto and homeowner's liability and extends it even further for a few $100s a year. That's not about lowering your premium. That's about making sure the coverage you're paying for actually protects what you built. So let me bring this all together. The goal isn't to pay as little as possible. The goal is to pay the right amount for the right coverage. That means shopping regularly so you're not overpaying for the same protection. It means bundling where it saves you money. It means carrying a deductible that reflects how often you actually file claims. It means stacking every discount you're entitled to. It means matching your physical damage coverage to the actual value of your vehicle. And it means carrying enough liability to protect your assets and your income, not just enough to satisfy the state minimum. The bottom line is that there's real money to be saved without sacrificing the coverage that actually matters. Most people just haven't had someone sit down and walk through it with them. That's what we do. If you want help figuring out whether you're paying more than you should, or if you want someone to look at your current policy and see where opportunities are, that's what we do. We work with individuals and families and businesses in Arizona, California, Nevada, and Utah. There's a link in the description. You can get a quote and we'll help you figure out where you stand. And if you haven't seen our video on why car insurance is so expensive right now, check that out right here. It explains the industry-wide factors that are driving these costs up, which is useful context for everything we just talked about. Thanks for watching.